A private equity firm hands you a letter of intent for your business. The headline number, say $10 million, hits exactly like the finish line you've been working toward for decades. But read further down the page, and you see the structural reality of the offer. They are putting $8 million in cash on the table and asking you to roll the remaining $2 million directly into the new company's equity. The buyers will call this alignment. They'll pitch it as a shared journey where keeping skin in the game means everybody wins together. The promise is a lucrative second bite of the apple, projecting your $2 million stake will triple when they sell the company in 5 years. Here is the reality check. Rollover equity is not a continuation of your past ownership. The moment the deal closes, that money becomes a brand new, highly illiquid investment inside a newly leveraged vehicle. If you prioritize the headline valuation over the structural reality of the new company, you are trading guaranteed risk-free closing cash for an illiquid stake that could easily become worthless. To understand how your money gets trapped, you have to understand the capital stack. This single hierarchy decides whether your rolled equity actually grows, or if it simply acts as a shock absorber for the buyer's debt. This chart visualizes a typical private equity structure. Notice the massive section at the very top. That is the heavy lender debt used to finance the purchase of your business. Right beneath that debt sits the private equity firm's preferred equity. This position guarantees their initial investment, and their returns are paid out before anyone below them sees a dime. And at the very bottom, carrying the most risk, sits your standard common equity. You are structurally crushed under the weight of the debt and the preferred shares above you. The private equity sponsor can talk about alignment all day. But if you and the sponsor sit in unequal, asymmetrical positions within the capital stack, the word alignment means absolutely nothing. That said, rolling equity does have valid financial utility. If you structure the terms correctly, keeping capital in the deal gives you 3 distinct advantages. First is tax deferral. Deal structures utilizing tax codes like Section 721 or 351 allow you to legally delay paying taxes on contributed equity. You only pay taxes on the cash you take out at closing. The immediate trade-off is that your deferred capital becomes entirely locked up for 5 to 7 years. You must ensure the cash you take at closing is enough to comfortably fund your life without touching the rollover. Second, leaving money in the deal signals extreme confidence to the buyer. Because you are reducing their immediate cash requirement, you can leverage that commitment to negotiate a higher upfront valuation multiple for your business. This graph illustrates the third advantage, the exponential math of the second bite. If the sponsor executes their playbook, your rollover builds massive wealth. But achieving that curve requires the market to cooperate and the firm to deliver operational improvements, pricing discipline, and add-on acquisitions. Rollover deals genuinely create a second payday under the right conditions. However, you are tying your net worth to a business plan you no longer legally control. Let's look at how this goes wrong. Consider a successful 48-year-old founder who rolled 30% of his equity. Because the letter of intent looked straightforward, he skipped hiring a rigorous M&A advisor to save on fees. The trap snapped shut right after closing. The sponsor executed a leveraged buyout and immediately aggressively loaded the newly formed company with debt. Then a sudden market downturn hit, and company cash flow shrank rapidly. The sponsor controlled the board, executing survival-first decisions to protect their own downside. The struggling business was forced into a distressed sale. This triggered the payout waterfall, the exact contractual order in which proceeds are distributed during an exit. In this distressed sale waterfall, lenders absorb the first wave of proceeds, filling the top bucket to cover debt. Remaining proceeds flow to the second bucket, where the sponsor's preferred equity absorbs the rest. Sitting last, the founder's common equity bucket stays entirely empty. In a leverage deal with preferred economics, your multi-million-dollar rollover can vanish entirely. You don't lose your money because the business stopped serving customers. You lose it because the structure dictated who absorbed the loss. If you choose to roll equity, you must stop acting like a captive seller. You are now a minority investor, and you have to negotiate like an institution. You do this by instructing your M&A advisor to secure 3 specific terms. The first and most critical safeguard is demanding pari passu economics. Pari passu means equal footing, forcing your rolled equity to share the exact same equity class and payout priority as the sponsor's equity.
The second safeguard is demanding minority governance rights, requiring board observation, monthly reporting, and consent over major actions. The third safeguard is pushing for a put option. This acts as a contractual escape hatch, giving you the legal right to force a buyback of your shares under strictly defined conditions. Demanding these structural protections requires immense leverage. Because you are shifting risk back onto the private equity firm, they may lower their initial cash offer to accommodate your safety. It's a necessary trade-off. Securing these safeguards is the only way to transform a volatile junior lottery ticket into a structurally sound, protected investment. Ultimately, deciding which path to take means mapping the deal structure to your current burnout level, your age, and your specific financial needs. This quadrant chart isolates the decision. Weigh your need for visibility and control on the y-axis against your tolerance for keeping wealth illiquid on the x-axis. If you seek immediate liquidity and won't monitor a sponsor's plan, you fit the clean break profile. Clean break founders should avoid the rollover, taking the tax hit for guaranteed cash. But if you believe in the growth plan, don't need cash today, and demand strict board visibility, you fit the sophisticated co-investor profile. Sophisticated co-investors should utilize the rollover as a wealth multiplier, provided they have successfully negotiated pari passu terms protecting their position. Do not let a massive headline multiple distract you from the fine print. The LOI offer price starts the conversation, but deal structure ultimately dictates your risk, your taxes, and your generational wealth.